The three words that appear in the approval letter your insurance company sends you before every surgery, every hospital stay, every major procedure they agree to cover, most people never read. And that is their entire strategy. Because those three words, subject to review, are the legal mechanism your insurance company uses to take back any claim they have already approved. After the procedure, after the hospital stay, after you receive the care you were told was covered. Months later, a different envelope arrives. Your claim has been denied. You owe thousands of dollars. Not because you skipped the authorization process, not because your doctor failed to submit documentation. You did everything right. You got the written approval. You followed every step. You showed up on the scheduled day and handed them your insurance card. It does not matter. Because buried in the approval letter, the one that said you were covered, were three words written specifically so that none of it had to be permanent. This is not a rare billing error. This is a deliberate, systematic, and thoroughly documented practice across the largest health insurance companies in the United States. It has a name. It is called a post-service denial, and the industry built to execute it at scale generated billions of dollars last year from people who did not know the approval letter they were holding was conditional. Before this video is over, I am going to give you a specific sentence language you can include in any prior authorization request that legally limits your insurance company's ability to use those three words against you. But first, you need to understand what is actually happening inside the approval process. Because what is behind those letters is something the industry has spent a great deal of effort keeping invisible. In 2023, the Government Accountability Office released a detailed report on Medicare Advantage prior authorizations. It found that Medicare Advantage plans reversed their own prior authorization denials in 75% of appealed cases. 75%. 3 out of every 4 denials were wrong. But that finding only covers initial denials, the ones that happen before you receive care. It does not measure what has quietly grown into one of the most significant sources of unexpected medical debt in this country: post-service denials. According to a 2022 survey by the American Hospital Association, 60% of hospitals across the United States reported a significant increase in insurance company demands to return money that had already been paid for authorized services. Not billing errors, not fraudulent claims, procedures that were pre-authorized, completed, paid, and then retroactively denied. When an insurance company demands repayment from a hospital or a physician practice, that provider does not absorb the loss. Their contract with the insurer requires them to attempt collection from the patient. So the patient who got the written approval, who showed up on the scheduled day, who paid their copay and their deductible, and trusted that the rest was handled, receives a bill for thousands of dollars they had no reason to plan for. The American Hospital Association estimated that in 2022 alone, the administrative cost to hospitals of managing insurer post-service reviews and recoupment demands exceeded $19 billion. $19 billion. Not paid to physicians, not paid for care, spent on paperwork for claims that were approved and then unapproved. 1 in 5 patients who receive a post-service denial report that they did not know they had the right to appeal. 1 in 5 paid a bill they were not legally required to pay. The average post-service denial that reaches the patient after the hospital's internal process is between $4,000 and $14,000. That is not a copay adjustment. That is a debt that arrives months after a procedure you were told was covered, with a due date, accruing interest if you put it on a card, damaging your credit if you do not. And it is arriving more often. The American Hospital Association found that between 2020 and 2022, the volume of insurer recoupment demands sent to hospitals increased by 31%. In 2 years, 31% more patients receiving bills for care they had pre-authorized approval for. If you have health insurance through your employer, through the marketplace, or through Medicare Advantage, everything I am going to show you in this video applies to your plan. This is not a niche problem limited to one insurer or one type of procedure. Stay with me, because in a few minutes I am going to show you internal documents from a federal lawsuit, documents that reveal how insurance companies set numerical targets for how many approved claims they intended to take back. When your doctor orders a procedure that requires prior authorization, the process is supposed to work like this. Your doctor submits documentation. The insurance company reviews it. They compare it against their clinical criteria. They issue a written approval. You schedule the procedure and receive care. That is what most people believe the approval letter means. Here is what the approval letter actually says. Every prior authorization approval issued by UnitedHealthcare, Cigna, Aetna, and Humana contains a version of the same language. The exact wording varies slightly. The legal function does not. This authorization is not a guarantee of payment. Benefits are subject to review of medical records and confirmation that services rendered are consistent with the information provided at the time of this request. Subject to review. Not a guarantee. That language, which appears in every approval letter, typically near the bottom in a paragraph that reads like a legal disclaimer, is a reservation of rights. It preserves the insurance company's legal ability to evaluate your claim again after the procedure, after the hospital stay, after you are home recovering. And that second review does not happen on a fixed schedule. It can happen 30 days after the claim is processed. It can happen 6 months later. In documented cases, it has occurred more than a year after the original authorization was granted. But here is what most people do not understand about that second review. It is not being conducted by the same people who approved your claim. The physician or clinical team that reviewed your prior authorization documentation and issued the approval is not the team that conducts the post-service review. In a large and growing number of cases, the post-service review is not conducted internally by the insurance company at all. It is outsourced. There is a multi-billion-dollar industry, an entire sector of companies that major health insurers hire specifically to identify previously paid claims that can be retroactively denied. These companies are called payment integrity vendors. Their compensation is structured on contingency. They receive a percentage of every dollar they recover. The more claims they deny, the more they earn. And here is the mechanism that makes this legally possible. The criteria applied in the post-service review are not required to be the same criteria that were used to approve the claim in the first place. The original approval was granted under whatever standard your doctor submitted documentation for at the time of the request. The post-service review applies a separate set of internal criteria, often more restrictive, and often updated after the original authorization was already issued. Your doctor met the standard. The procedure was approved. The surgery happened. And then the standard changed. Here is a specific example of how this works in practice. UnitedHealthcare's internal clinical criteria for approving a lumbar spinal fusion surgery requires documentation of 6 weeks of failed physical therapy before authorization will be granted. That standard is communicated to physicians through the prior authorization portal. Physicians submit documentation that meets it. Authorizations are granted. UnitedHealthcare's payment integrity vendors, reviewing the same claims post-service, apply a different internal standard, one that requires documentation not just of physical therapy duration, but of specific outcome measures, pain, scale assessments, functional limitation scores recorded at specific intervals. Most physicians do not know those outcome measures are required. They were never listed in the original criteria. They appear in the post-service review framework. The authorization was granted under Standard A. The claim was denied under Standard B. The patient received a bill. Your doctor met the first standard, he did not meet the second. And the second is the one that determines whether you owe $11,000. The only reason any of this is legally possible is 3 words. But what federal investigators found inside the companies executing these reviews will make clear that this is not an administrative oversight. Let me tell you about Robert. Robert is 57 years old. He lives in Dayton, Ohio. He has been covered under the same employer-sponsored health plan through a large manufacturing company for 19 years. 19 years of premium payments, not one gap in coverage, not one prior claim denial in his history. In the spring of 2023, Robert's orthopedic surgeon recommended a total knee replacement. Robert had been managing chronic knee pain for 3 years. His surgeon had already tried every conservative option: 2 separate courses of physical therapy, cortisone injections at 6-month intervals, 14 months of prescription anti-inflammatory medication. The joint continued to deteriorate. His surgeon documented all of it: the failed alternatives, the progression of the condition, the clinical basis for surgical intervention. Robert's surgeon submitted the prior authorization request to Cigna. 11 days later, Cigna sent the approval letter. Robert read it. It confirmed the procedure. He scheduled the surgery. On the morning of the procedure, he paid his $600 copay at the registration desk, filled out his paperwork, and was told everything was in order. The surgery went without complications. Recovery began. His surgeon was satisfied with the outcome. 8 months later, Robert received a bill from his orthopedic practice: $11,200. The attached letter explained that Cigna had conducted a post-service review of his claim and determined that the procedure did not meet clinical criteria for medical necessity based on the documentation submitted at the time of Authorization. The same documentation Cigna had reviewed when they approved the procedure. Robert called Cigna. The representative confirmed the claim had been retroactively denied. Robert asked how a procedure they had pre-authorized could be denied 8 months after it had already been performed. The representative told him the approval letter stated that authorization was subject to review. Robert said he had followed every step of the process. He had gotten the approval. He had not been told any additional documentation was required. The representative said the clinical review team had reached a different assessment. Robert asked to speak with the physician who conducted the post-service review. He was told that was not possible. What Robert did not know at that moment was that he had the right to appeal. He had the right to demand the specific clinical criteria Cigna applied in the post-service review and compare them to the criteria used in the original approval. He had the right to an independent external review by physicians with no financial relationship to Cigna. And under federal law, he had documented grounds for reversal if the post-service criteria differed from those used at authorization, which, as you will see shortly, they frequently do. He found out 5 months later, after a patient advocate helped him begin the appeal. Cigna reversed the denial. The $11,200 was covered, but Robert had spent 5 months living with an $11,000 bill. He put $1,200 on a credit card before the reversal came through. The interest on that balance does not get reversed. Robert's story is not exceptional. The American Hospital Association collected data from member hospitals nationwide. In 2022, 60% of hospitals were managing exactly this scenario: pre-authorized procedures, completed care, retroactive denials delivered to patients months after the fact. Robert is not the worst case. Robert is the median, and it is not over for the people who do not know what he eventually learned. But here's where it gets worse. What I have described so far is the version of this practice that insurance companies would acknowledge if pressed: a post-service review, a reassessment, an internal quality control function. What is actually driving much of this is an industry that the people writing your approval letters have been very careful not to mention. Major health insurance companies, UnitedHealthcare, Cigna, Aetna, and Humana, among them, contract with third-party firms called payment integrity vendors. These are not clinical organizations. They are data companies. Their product is identifying previously paid claims that can be retroactively reversed. They are paid on contingency. Every dollar recovered from a hospital or billed back to a patient comes with a percentage that flows back to the vendor. There is no financial model that rewards finding that a paid claim was correctly approved. There is no incentive for confirming that the original authorization was properly granted. The compensation structure pays on reversals, on recovered dollars, on claims that were approved, completed, and paid, and that can be reopened. Two of the largest payment integrity vendors in the United States, Codivity and Multiplan, collectively process hundreds of millions of claims annually on behalf of commercial and government insurance programs. Their published performance data shows recovery rates that translate to billions of dollars returned to insurers each year from claims that had already been processed. Those recoveries come from somewhere. In 2023, the Senate Finance Committee launched a formal investigation into payment integrity vendors and their role in retroactive claim reversals. The committee found that the post-payment audit market had grown into a multi-billion-dollar sector operating with almost no direct federal oversight and no uniform standards for what criteria vendors could apply in reviews. Conducted after care was delivered. No uniform standards. The vendor reviewing Robert's claim was not required to use the same criteria Cigna used when they approved it. They were permitted to apply stricter, more recent, or internally developed standards that had never been communicated to Robert's surgeon at the time of authorization. But what the Humana class action lawsuit produced goes further than that. Stay with me, because the documents from that case are part of the federal record, and what they show about how these targets are set is the part they most want you not to see. A class action lawsuit was certified against Humana in federal court. The plaintiffs were patients and families of patients who had received prior authorizations for post-acute care following surgery or hospitalization, skilled nursing stays, home health visits, inpatient rehabilitation, care their physicians had ordered and that Humana had approved in advance. Discovery produced internal company documents. Those documents showed that Humana had established internal targets for post-service denial rates, not targets for identifying fraud, not benchmarks for catching billing errors, numerical targets for what percentage of pre-authorized, already paid claims the company intended to retroactively deny each quarter. And regional managers were evaluated in part on meeting those targets. The target was not a byproduct of finding problems. The target came first. The reviews were conducted until the number was hit. In 2024, the Centers for Medicare and Medicaid Services published federal audit findings from a review of Medicare Advantage claims across multiple major insurers. The audit found that 11.4% of post-service denials were issued on claims where the documentation in the original authorization file fully and clearly met the clinical criteria for coverage. 11.4% of retroactive denials were wrong by the insurance company's own standards. They were denied anyway. The American Medical Association tracked the physician side effects of this across 3 consecutive survey years. In their 2023 report, 68% of physicians reported that their patients had received unexpected bills for care that had been pre-authorized. 68% of physicians. That is not an anomaly. That is the operational standard. And it is possible because of 3 words written into every approval letter by every major insurer in this country. Subject to review. So what does this mean for you? It means that an approval letter from your insurance company is not a contract, it is a conditional statement. And the condition was written specifically to preserve the insurer's right to apply a different standard after the fact by a third-party vendor paid on the percentage they recover under criteria you were never shown, and that your doctor was never told would be applied. But here is what it also means. There are specific steps you can take before you receive care, and after that, significantly limit your insurance company's ability to execute a retroactive denial against you. The most important one starts before you walk into the facility. Step 1. When you receive a prior authorization, do not treat the letter as the end of the process. Call your insurance company and say this: I am requesting written documentation of the specific clinical criteria that were applied to grant this authorization, and confirmation that those same criteria will govern any post-service review of this claim. Write that down before you call. Read it if you need to. That request creates a formal paper record that you are aware of the post-service review process. It establishes your expectation, on the record, that the review standard will be consistent. When an insurer receives that request, they face a documentation obligation. Their response, whatever it is, becomes part of your claim file. If a post-service review then applies different criteria, the gap between their written response and what was actually used is the foundation of an appeal. Step 2. Ask your doctor to include specific language in the prior authorization submission. The language is, all clinically appropriate conservative treatment alternatives have been attempted, documented, and determined to be insufficient. The recommended procedure represents the current standard of care for this patient's condition as of the date of this submission. That language directly addresses the 2 most common bases for retroactive denial: that documentation at the time of authorization was incomplete, or that alternative treatments were not exhausted. If both are explicitly addressed in the original submission, a post-service reviewer cannot retroactively claim the approval was granted on insufficient information. Step 3. When your explanation of benefits arrives after the procedure, review it before filing it away. Confirm that the procedure code on the EOB matches the code in the prior authorization approval. A discrepancy between the 2, even a single digit, can be used as the basis for a post-service denial. If you see a mismatch, report it in writing to your insurer immediately, before any post-service review window opens. Step 4. If you receive a retroactive denial, treat it as step 1 of a process, not as a final answer. Under ERISA, the federal law governing employer-sponsored plans, and under Affordable Care Act regulations for Marketplace and Medicare Advantage coverage, you have the right to appeal any adverse benefit determination. That includes a post-service denial. The insurer is legally required to provide you with 4 things in writing: the specific reason for the denial, the specific clinical criteria applied in the post-service review, the name and credentials of the reviewing clinician, and an explanation of how those criteria were applied to your case. Request all 4 in writing the day you receive the denial letter. Do not call. Send a written request by email or certified mail. A phone call creates no record. A written request does. And in an appeal, the record is everything. If the post-service criteria differ from those used in the original approval, which, based on the Centers for Medicare and Medicaid Services audit data, occurs in a documented percentage of cases, that discrepancy is the central argument of your internal appeal. Your doctor's letter of medical necessity, combined with evidence that a different standard was applied post-service, is the documented basis that reversal rates are built on. If the internal appeal is denied, you have the right to an independent external review. An independent organization staffed by board-certified physicians with no financial relationship to your insurer reviews the denial from the beginning. Federal data shows that patients who pursue external review of post-service denials win approximately 58% of the time. More than half. That is not a long shot. That is a formal federal process with a majority success rate that most people never reach because they paid the bill instead. Now, I told you at the beginning of this video that I was going to give you a specific sentence language you can include in a prior authorization request that limits your insurance company's ability to use those three words against you. Here it is. After you receive a prior authorization approval, send this in writing to your insurer's member services address by email if it is available, by certified mail if it is not. Keep a copy. I am requesting written confirmation that this prior authorization, once granted, constitutes a determination that the described service is medically necessary and that any post-service review of this claim will apply the identical clinical criteria used to issue this authorization. Please confirm this in writing and retain this request as part of my claim record. That sentence does three specific things. First, it creates a documented record that you submitted this request before receiving care. Second, it formally establishes your expectation that the standard used to approve the procedure is the standard that will be used to evaluate it afterward, not a stricter version, not one developed by a third-party vendor after the fact. The identical criteria. Third, it triggers an obligation. If the insurer responds and the paper trail you created gives them incentive to do so, their response becomes part of your claim file. If a post-service review then applies a different standard, the gap between what they confirmed in writing and what was actually applied is not a gray area. It is a documented inconsistency. And in an appeal, a documented inconsistency in the insurance company's own position is one of the strongest grounds for reversal you can present. Insurance companies do not want you sending that sentence. Send it anyway. If this is the kind of information you want, the specific federal investigations, the internal targets, the exact language your insurance company is counting on you never learning to use, subscribe to this channel. This is what I cover. Every single video. There is something else happening in the health insurance system right now that is costing Americans billions of dollars a year and that most people have been told is completely normal and legal. It is not. Subscribe so you are here when I cover it. Here is the truth about those three words. Subject to review. They did not end up in your approval letter by accident. They are the legal architecture of a system that employs entire companies paid on the percentage they recover to find reasons to deny claims that were already approved. UnitedHealthcare, Cigna, Humana, Aetna. They approved Robert's surgery. They sent the letter. They accepted the copay at the door. 8 months later, they sent a different letter. Robert did not know, when he received the approval, what the approval actually said. You now know what it says. And you now know what to send before you walk into that facility.